Hey guys, welcome back to another episode. It's good to have you back and watching. I'm going to try and make this one a bit short as there's not much to update, so I'm just going to do a quick update on some of the more important changes and movements that I've seen within my portfolio. On a side note though, how good is it to see that the market is slowly starting to recover? I know, looking at my portfolio, it's starting to get back close to the low positive percent returns, and I hope your guys' portfolios are doing great also. So first on the list, we had ABR. ABR paid out its second dividend of the month after a slight dividend increase per share of 40 US cents to 42 US cents. Not much has changed for the stock apart from gaining 9.64% in capital value over the month of May. The company managed to increase its dividend 11 times out of the last 13 quarters and boasts a dividend increase of 11% in the last year, which is absolutely whopper. It should be noted that the housing market is slowing and future decreases in market performance could lead to higher defaults over in the US markets. Regardless of this, analysts still believe and have for the past 3 months that ABR is a strong buy, and looking at its performance to date, I can't disagree with him. I'm going to continue to buy ABR with any spare money I have available. Next on the list we had ACP. These guys paid its second to last payment to my portfolio, with July being its last. This is as I crunched the numbers and I realized that even if I sell my position at the current loss of 90 or so US dollars and then reinvest that sum into AGNC, I'd be netting more dividends from AGNC alone compared to a combination of the two. It's no doubt that ACP has been failing for a while, and I don't have much hope for the future of the company. AGNC, however, is much of a likeness, and it's in a much better financial position to take any financial hits and be able to recover quicker. The EPS and revenue has been negative for 3+ years, and market cap is also only at 354 million USD, which is 5.49 billion USD less than AGNC's market cap. And although AGNC also has experienced negative income, they've been able to experience positive income in 2 out of the past 4 years. AGNC also has greater in-position cash flow in terms of their trailing 12 months, less of a repayment on debt regardless of their larger size, and greater free cash flow, which is essential to survival in high interest rate periods such as the one that we're experiencing right now. All in all, it would have been great if I could have waited and not taken as much of a loss on the stock by selling it in the manner that I did, but by doing so I would have then had to buy AGNC at a higher price, as when ACP recovers it's more than likely that AGNC will lose too. In my eye, it was better to buy now then wait and buy potentially less of AGNC and suffer more of a loss with ACP. Our next dividend came from AGNC, who paid out a dividend of $1.91, which now brings the total paid by AGNC this year to $11.22. Apart from me increasing my position by a mere $97.35, which equates to a dividend increase of around $1.13, not much has changed. As stated last month, the stock is still trading under its fair value, and their predicted 3-year return on equity has stayed the same. This is a type of stock that won't pay off as an investment until 10 to 20 years in the future, as the mortgage market is currently not attractive for purchasers due to high interest rates attached to these mortgages. Once the market levels back out and buyers are more confident that they're going to get a bargain on their purchase, is when the company will start to make more of a stable return. Until there, I'm just going to continue to buy and hold, and then hopefully see a stable return in the future. This month we had the first payment of the Smartshares funds paid into my portfolio. First on the list was ACP, which is the Smartshares Australian Property Fund. They had their first dividend of $6.16. Smartshares, for those who don't know, is a NZ fund manager who offers over 40 different diversified funds ranging from ESG funds, bond funds, Asia, US, Australia or NZ based funds. ACP is made up of holdings such as Stockland, Ingenia and Centura. They have a 5-year analyzed return of around 1.98% after tax, which isn't amazing, as you could definitely get more from other REITs or ETF-based REITs. However, I invested there to try to diversify myself away from just the US and NZ property markets. What I may do in the future, if I become more confident, is sell up and buy some of the top 3 performers within the portfolio, but for the meantime, I'm happy to pay a bit of a fee and relax and let the managers do the work for me. The property market in Oz has remained strong even after they have endured 12 interest rate hikes, as well as the high inflation we're all experiencing. Property values across Australia's 5 city centres have increased by 2.8% per annum, and the average sale price is down negative 5.1% from 12 months ago. But it shows a confidence in the idea of the home as an asset, as regardless of the high inflation and interest rates rises, the average house price has still risen. As for ASP, the stock has dropped by 10.98% over the last year. the stock will definitely bounce back after inflation and interest rates have stabilised. So this could be a good time to buy, and as the current price is 0.356 New Zealand cents off its 5-year low. However, if you're more confident, I would advise investing directly into individual property-based stocks and REITs, which could offer you a greater return. One of my favourite Oz REITs is NSR, which is definitely worth your attention. Next payments came from BlackRock Science and Technology Fund, who paid $2 and 1 cent, bringing the yearly total to $10 and 44 cents. Again, not much has changed last month, and there isn't much news to share today. The price in last month has risen from $33 and 97 cents to $34 and 42 cents. We then had a payment from one of my more favourite dividend payers, Cogent Communications, who paid its second dividend from the year, which came in at $18 and 51 cents, bringing the total paid to $35 and 95 cents. With 2 more quarters to be paid, I'm hoping that this will net close to $75 this year. Each quarter they've managed to increase their dividend. This goes as far back as 2013. The below graph is a dividend investor's wet dream and provides us with great confidence that their business performance and growth is on the right side of zero, which therefore allows them to not only continue to pay a dividend, but to grow it too. We then had another dividend from a Smartshares fund. In particular, this one came from New Zealand Dividend Fund. This fund is made up of New Zealand's biggest dividend payers, such as Fletcher's, Meridian Energy, Contact Energy, Spark, as well as many others. The 5-year investor returns after fees and taxes at 28% end up being 5.23%, which isn't amazing, but I enjoy having this fund purely as a way to hedge the market. If the market does well, I'll do well, and vice versa if not. It's a very average holding, but average is safety, and sometimes it's better than chasing high yields. This holding almost acts as a hedge against myself and any poor judgment calls I make as a way to offset them. Next we had Ellington Financial, who continued to pay its 15 US cent dividend per share, which ended up netting the portfolio $5 New Zealand and 52 cents. For this year so far, EFC has earned me $26 New Zealand and 81 cents. Last month, EFC did finally agree to purchase AIC, Ellington Asset Investment Corp, which is a REIT that invests primarily in mortgage-related assets. What this means for EFC is that they will now assume Arlington's outstanding preferred equity, senior unsecured notes, and trust preferred securities. It will allow EFC to increase their capitalization past $1 billion from $854 million US, and then give them greater efficiencies in OPEX while increasing the scale of their operations and enhancing access to capital markets. Hopefully, with this newfound financial sway, EFC will be able to bring the company out of the slight rut it is in and reverse its negative earnings per share. Interestingly enough, over the past 6 months, EFC stock has lost 9.7% of its value, and AAC, up until the point in time of the finalised deal, has lost negative 8.78%. Post-deal, it gained 32.5%. EFC will be the stock that I'd only invest dividend back into and not any extra money I free up during this period in time. Next on the list, we had ETY, who paid another monthly payment, ended up being $2 New Zealand and 91 cents, which brings the yearly total to $30 New Zealand and 56 cents. Again, there isn't much to mention with Eaton Vance this month. Next, we had a payment from Smartshares New Zealand Top 50, who paid $7 New Zealand and 6 cents. New Zealand has been feeling inflation and interest rates just as much as the rest of the world. 2022 ended up with the economy shrinking by 0.6%, after the Reserve Bank of New Zealand predicted a 0.7% growth. GDP fell a further 0.1% during the first quarter of 2023, placing New Zealand into a technical recession, which is, for those who don't know, 2 or more quarters of negative GDP. People believe this is brought on from interest rate hikes at a rate which far outpaces the US Federal Reserve. With that being said, economic effects of the interest rate hikes won't cause a real recession until the latter half of 2023 and into the early half of 2024, especially in the labour markets of 2024. The stock itself has more or less moved sideways since the last 6 months, but I believe that the stock will react to the market in a negative way at the back end of 2023. So it could be worth investing a portion of money then to get the stock at a discounted rate, which I'll be keeping an eye on. FSK then paid its third payment, which landed us at $37 New Zealand and 45 cents. Payment this time around was a mere $1 New Zealand and 38 cents after paying a portion of the dividend at 0.5 US cents per share. The remainder will be paid in July at 0.7 US cents per share. The NAV for FSK has declined by 32% over the last 5 years, which doesn't bode well for stock, as it essentially suggests that the securities FSK is holding are moving in a downwards trend, as the price of securities held by a scheme and the NAV move in tandem and are representative of each other. Again, another negative thing about FSK is that its PIK, or payment in kind income, is well over the 2 to 8% mark, that is considered safe. Payment in kind is a way of paying for a good or service through bartering, e.g. instead of paying rent for a room, you instead pay through maintenance of the house or grounds. In the case of BDCs, payment in kind is utilised by, in some cases, agreeing to pay back the interest at a later date, but with a greater interest rate applied. When the rate of payment in kind is over 8% or even 6% for that matter, it can be a sign that companies within the BDC's portfolio are not able to pay interest expenses in cash, which could cause credit issues and higher default rates in the coming quarters. In FSK's case, payment in kind is currently at 42%. If you're looking for a BDC to invest in, it's probably worth looking at BDCs such as Main Street Capital, Gladstone, or Horizon, as they offer a better NAV and security in terms of both their dividend and capital performance over the last year. Our next payment came from Horizon. Horizon paid out another monthly dividend of 11 US cents per share, which came to a total of $9.47 for the month. Right now, the stock is paid as close to 52 New Zealand dollars 98 cents for a 1,976 New Zealand dollar position, or roughly 84 shares. Not much has changed thus far for the month of June, and it still looks to be a strong buy for future returns. I'll continue to buy this when I can. Next we had Infratil, who paid its first of its semi-annual dividend, which ended up netting the portfolio 41 New Zealand dollars and 69 cents for a DPS of 17 New Zealand cents per share. For those who don't know, Infratil is one of my favourite stocks after being able to generate a total shareholder return of 250% over the last 5 years. To give perspective on that, to date Bitcoin has returned negative 43.49%. In the past year, 23% of this 250% of the total shareholder return was generated. On top of that, thus far in 2023, IFT looks to continue the strong market performance trend by increasing both their revenue, earnings per share, and therefore profit margin. The final major positive for this holding, which is always good to see, is that insiders last year have spent over 2.5 million New Zealand dollars on acquiring shares, none of which have been sold in the meantime, which indicates a strong backing and belief that the company will continue to be profitable. The only slight thing to keep an eye on is that their debt is still reasonably high at 54.8%. However, this is being paid down year over year, and if they can continue this, then their high profitability will not be an issue. IRBO, which is the iShares Robotics and Artificial Intelligence ETF, finally paid out a dividend worth 15 US cents per share, which equated to 2 New Zealand dollars and 10 cents. Between November 2021 and October 2022, the stock hemorrhaged its value, dropping from 56 US dollars and 86 cents to 24 US dollars and 30 cents, which equates to a pretty much a negative 50% drop in value. Since then, it made a slight recovery by maintaining the present day value of 34 US dollars and 70 cents. I believe that this stock is out of the worst for the immediate future, and with the world moving more and more towards AI, I believe that this stock will be able to offer you some great returns in this area of the market. I'm still standoffish and won't invest more than what I'm okay with losing, however. In saying this, I am bullish on Microsoft, Horizon, and BST, which do invest in the same areas as far as AI go. Reason being, I'm yet to see a reason to trust the fund managers at iShares as much as I do at Horizon and BlackRock. I find the management fees of 0.47% quite high for what it offers, especially as returns haven't been the greatest as of recent. However, if you are happy to take on a bit of risk, then it's definitely a slight deal if you can scoop up some of these shares at the current 34 US dollar price margin. The New Zealand clothing company Kathmandu paid a dividend of 1 New Zealand dollar and 69 cents. The outdoor clothing industry was hit hard by COVID-19. KMD was forced to raise capital, which diluted shares, and ever since then, the company has been finding it hard to regain shareholder confidence. The price of KMD at current is very volatile, and in the last 3 months, it's moved from highs of 1 New Zealand dollar 38 cents to lows of 1 New Zealand dollar and 5 cents, which represents a 31.4% price change. During the volatility, you may be able to pick up KMD for a bargain during one of its price movements, but as I'm more of a value investor, my advice would be to stay away, even if you do think that buying a large amount of the stock at low price and dumping it in 5 years' time is a good option. The PE ratio of KMD at 12.48 is currently just under the average 12.51 of other stocks in the specialty retail industry, and therefore reasonably priced. If you are interested in purchasing their stock, I would wait until KMD proves itself over the next few years through generating strong cash flows and generating a good balance sheet. Bill paid us another 21 New Zealand cents after his stock went ex-dividend. The stock has done incredibly well recently with the advancement of AI. However, as I have such a minute position, it's not really worth talking about. I do still believe Microsoft has more left to climb, especially through their AI investments. I don't believe you could go wrong by increasing your position in the stock, purely due to the added security of their historical dividend and capital performance. New Zealand Bond Fund paid out its second dividend this month, netting $4.13, which brings the total amount paid this year to $8.30. 2022 caused bonds to drop almost as much as stocks, with longer-term bonds being slammed harder than shorter-term bonds, which managed to limit their losses to around 4% compared to 12 to 31% of the longer-term bonds. This was due mostly to super low interest rates remaining after COVID-19 affecting the bond market. Bonds performed relatively well for the first portion of the year, as they represented the safe, reliable form of income against stocks and other forms of assets during these recessionary times. Due to high interest rates, they were able to generate a solid income. For instance, rates on short-term bonds in 2022, 3-month and 2-year periods, were around 0.06 and 0.75%. Now they yield close to 4.35% and 4.75%. I believe it's always a safe option to have a position in the bond market, which could be topped up to represent more of your portfolio the closer you get to retirement. Prospect Capital paid another monthly dividend of $0.06 per share, which netted us $18.32. This brings the yearly total paid by the stock to $103.77. The stock itself is not performing well as of late. Its NAV per share has declined by $0.46 a share, or 4.6%. As I mentioned before with FSK, payment in kind income is an indication that credit issues could and are rising in a BDC's portfolio. In terms of Prospect Capital, this has now increased from 14% to 24%. Prospect did for a while have a better total return from 2020 until 2023 than some of the more quality BDCs out there, such as Main Street or Gladstone Capital. However, Prospect Capital now has a price to net asset value ratio of 0.66 compared to Main Street Capital's ratio of 1.45. It puts it in a very volatile position as being one of the more risky BDCs out there. One of Prospect's major holdings, PGX Holdings, caused a drop in NAV after PGX filed for bankruptcy. The investment in PGX accounted for $250 million, or 3.3% of Prospect's portfolio and 5% of Prospect's net asset value. What's worse is that Prospect's other positions in First Tower Finance and National Property REIT, along with PGX, Interdent and Valley Electric, account for almost 40% of the total Prospect portfolio, or 79% of their net asset value per share. This high concentration is especially risky, and if the unrealized gains from these investments were marked back down to cost, then the current net asset value per share would drop from $9.48 per share to $6.98 per share, which is not an unlikely outcome in a recession. Therefore, I'm toying with the idea of reducing my position in Prospect and reinvesting into less volatile BDCs. Our fifth to last payment of the month came from QALD. We were paid another monthly dividend, including a bonus dividend of $2.73, which brought us to $18.68. There's nothing much to update in terms of QALD, apart from the fact that ever since the end of 2022, it started to make a slight rally and return from its low of $15.39. We were then paid our second dividend of the quarterly dividend SVLK pays to its shareholders this month. The dividend came in at $7.32, which equates to a decrease in DPS of negative 41.7%. The yearly total paid by the stock now sits at $18.60. The shipping industry itself has taken a bit of hit from the COVID-19 era, and SBLK itself is expected to report an earnings per share of $0.63 per share, which is a reduction of 68.5% compared to the same quarter last year. This is due to the fact that during COVID-19, shipping companies were unable to ship their typical demand due to heavy restrictions being placed on the workplace. Once restrictions were eased, an influx of the need for dry bulk such as steel, fertilizers, or grains skyrocketed to help jumpstart international economies to their pre-COVID productivity levels. Since then, demand has since eased, as well as the shipping industry's profits. Currently, the stock is having what I believe to be a bit of a correction, as its high-paying dividends and incredible gain between 2020 and early 2022 would have brought on many more Prospect investors, hence bolstering its price. I'm going to hold on to the stock for the meantime, as valuation models show that this stock to have an intrinsic value in the mid-30s. Their current return on capital employed is 12% higher than the industry average, so there is some positive signs within the company. It's also reassuring to hear the president of SVLK wanting to act for the benefit of the shareholders, as they too are shareholders and therefore incentivize a focus on dividends and strong shareholder returns. This is evident in their dividends policy, where they paid over 80% of the net income out as dividends last year. Stride Property also paid its second quarterly dividend for this year. The New Zealand REIT paid $1.27, which brings the yearly total to $3.91. For financial year 23, Stride has seen strong rental growth rates throughout its portfolio, increased by 7.1%. Unfortunately, higher interest rates on loans have caused a lower portfolio valuation of $118.5 million. This equates to around a loss after income tax of around $116.7 million New Zealand dollars. For comparison's sake, in financial year 2022, SPG generated the profit after income tax of $112.3 million New Zealand dollars. To combat this loss, SPG is looking at selling one of their $30 million assets, as well as implementing a dividend reinvestment plan to retain profits and reduce its interest debt payments. Not the best news for SPG and its shareholders, but it's a necessary action to take for the health of the company. Once interest rates start to reduce, we should see the company be able to gain high profits, especially due to its rental growth rates. STAG Industrial paid another monthly dividend of $0.12 per share, which equated to $3.69 for my holding. The total income for the year generated by the stock now sits at $21.73. With quarter two earnings being more than what it was hoping for, the future looks bright for STAG. This year alone, they've been able to gain 11.8% compared to the sector's average of 4.3%. Their net operating income has also risen by 7.8% year over year. REITs have been benefiting from high occupancy rates and demand, which have increased lease rates by 30.6% on renewals. What is also going to benefit STAG in the future is that it's expected for e-commerce sales to grow to 30% of the retail sales by 2030. For perspective, e-commerce retail sales were 6.6% of retail sales in 2014 and 16% in 2022. As always, I'd recommend looking into the stock where possible due to its strong dividend and strong prospective capital returns in the future. Smartshares New Zealand Property Fund paid the first of its semi-annual dividend, which netted us $38 New Zealand dollars and 21 cents in total. I haven't been investing heavily in this fund, so it's only a $1 New Zealand dollar and 17 cent increase since the stock's final payment in December 2022. The stocks which this fund invests in, such as Kiwi Property, Goodman Property, Precinct Property, and Stride, have either taken a slight hit or remained pretty stagnant. This is due to the hike in interest rates, which has then increased the payments needing to be made by these companies on money they have borrowed. High inflation has also affected these REITs by either reducing tenants' income and in some cases their ability to pay rents, which results in higher vacancies, as well as an increase to the bills on any current construction projects these REITs have underway. New Zealand property prices have also fallen, which has reduced the value of these REITs' portfolio and thus the value of MPF. Due to this, MPF has had to reduce their dividend ever so slightly since November 2022. Although average property prices have dropped, the market's upwards trend will most likely only slow for this inflationary period, then correct itself and return to a slower growth rate, which can only mean positive things for MPF. For your reassurance, the last downturn in 2008 only lasted 18 months. Our last payment came from Sixth Street Capital, who paid out 0.42 New Zealand cents per share after its 4 New Zealand cent per share bonus dividend last month in May. The company continues to generate strong income from its low volatility and well-diversified portfolio of middle market companies to invest in. Their current net asset value price ratio is 1.15, which is the fourth highest out of USA's 25 most common BDCs. Their total asset value has been growing year over year, and what's positive about this company is that it's invested in 17 different broad sectors. What I don't like is that 76.2% of its portfolio lies with the supermarket company, top three in markets. I think that's putting them in a position similar to Prospect Capital, where too much dependency on one investment could cause large financial damage if tops were to default on their loan. In total, as I said, we've netted $284 New Zealand dollars and 76 cents for June, which was 27.53% higher than the same month in 2022. We're now halfway through the year, and the dividend payments from the portfolio are tracking well. Compared to the same point in time in 2022, we're at $651 New Zealand dollars and 43 cents. Now currently in 2023, we've come close to doubling that income, which represents an 84.6% increase. Our entire portfolio dividend yield is now at 5.53%, which is creeping up. However, I'm not too worried as long as I keep it between the upper echelon of the ideal 2 to 6% rate. My forecasting has been a bit off for the past few months, so I'd expect to earn only around $200 for the month of July.